the New York Fed says the number of Americans that are tapping into their home equity lines of credit is growing. Balances on HELOCs, or home equity lines of credit, have risen around 20% since hitting a low toward the end of 2021. And a new survey from Bankrate revealing the top reasons to tap into home equity. Here with more, we've got Jeff Ostrowski, who is the analyst over at Bankrate. Jeff, great to have you here. We'll get to the survey. I just want to start with the basics here. Just share with our audience how people can tap into their home equity and the pros and cons of these methods.
Well, there are a few main ways for homeowners to tap into home equity. The traditional way for a long time was through something called a cash-out refinance. So you refinance your mortgage for more than you borrowed on the original mortgage. You pay off the first mortgage, you get a check for $50,000 or $100,000 or however much it is that you want to pull out of the home. That has pretty much disappeared. Nobody's refinancing right now. Even though mortgage rates are back under 7%, they're still well above the levels that many Americans have locked in their mortgage rates at. So cash out refinances are pretty much gone, and they've been replaced by home equity loans and home equity lines of credit. And so that's reflected in those rising numbers that you just showed from the New York Fed.
And so just to follow on that, what are some of the pros and cons of tapping home equity lines of credit?
Well, the pros are that these home equity loans, home equity lines of credit have interest rates that are lower than credit cards. So credit cards now are 20% plus. You can get a HELOC or a home equity loan for maybe in the 8%, 9%, 10% range. So definitely cheaper than credit card debt. Certainly more expensive than mortgage debt, but you are able to just keep that 3% mortgage or 4% mortgage in place and untouched, and then tap into your home equity through a home equity loan, home equity line of credit. So HELOCs come with variable rates, so that's a minor downside. Home equity loans have fixed rates, and then in terms of cash out refis, those are the disadvantage to that is that you're giving up your older rate and borrowing money at the new market rate.